ICICI Nifty IT Index Fund NFO. Will this NFO add return potential or risk potential? Let us analyze. Hi, this is Ramalingam. We help individual investors like you to take right financial decision so that you can reach your financial goals faster and smarter. In the first segment, let us understand some key details about this particular NFO. Then we will understand by dissecting Nifty IT index and its performance. Then we will analyze pros and cons of this NFO. Then we will go to the final take. What are the key features of this NFO? This NFO is open till 8th August 2022. It is an open-ended equity fund, comes under index fund category, especially in sectoral index fund category. The benchmark index is Nifty IT Total Return Index. Minimum investment is just 1,000 rupees. There is no exit load. Fund manager is Gazat Eglin. What is the investment objective of this fund? This fund aims to generate returns by investing in the basket of Nifty IT index stocks. This fund manager is going to simply replicate and mimic the Nifty IT index as such. He is going to buy the same set of stocks in the same weightage. By doing that, he is trying to create long-term wealth. He will try to create similar returns as of Nifty 80 index, subject to tracking error and expense ratio. The investment strategy of this particular index is this: based on the free float market capitalization, the index has already selected top 10 IT companies. This index is going to have only 10 stocks. So heavily concentrated portfolio. This index is not having like other index like 30 stocks, 50 stocks, 100 stocks. No, only 10 stocks in the index. So it is a very concentrated index. Concentration can add more risk and more return. So if you are looking for exposure to top 10 IT companies based on market capitalization, then this fund may be suitable one. Otherwise, this can add more risk to your portfolio. The fund manager will buy the same stocks in the Nifty IT index in the same weightage. In other words, he is going to simply cut, copy, paste the Nifty IT index in this ICICI Nifty IT index fund portfolio. What are all those 10 stocks in the portfolio? Infosys 26%, Tata Consultancy Services 26%. If you sum up, this itself comes to 53%. Two stocks has got 53% weightage in your overall portfolio. So the entire assets under management, 53% will be invested in just two stocks. So remember the concentration first. Tech Mahindra 9%, HCL Technologies 9%, Wipro 9%, Emphasis and Mindtree L&T 4%, Coforge 3.24, L&T Technology 2.08. So this portfolio is going to be of top IT companies, no doubt, but however, highly concentrated portfolio both on number of stocks and also on the weightage wise. What is the kind of past returns this particular index has delivered? Total return index, Nifty IT index has delivered in the last 1 year minus 2.67% in negative return. Last quarter return and the last calendar year return is also considerably negative here. However, in the long run, like 5 years time frame, this fund has delivered 24.75% annualized return. So just like any other equity fund, this fund is volatile in the short run, has got the potential to deliver negative returns in the short run. Also in the long run, this fund has delivered inflation beating return. Being an IT index, That means a sectoral fund. Instead of having a normal equity fund waiting period of 5 to 7 years, if you have 7 to 10 year waiting period, it will be better. So if your investment time horizon is super long term, not just 5 to 7 years, 7 to 10 years, then this fund may be suitable for your portfolio. If you look at the performance of this particular index in the last 1 year vis-a-vis the other major indexes in the Nifty, IT index is one of the index which has delivered negative returns among many other indexes. However, there are few other indices like Nifty Auto, Nifty Energy, Nifty Media, Nifty Oil and Gas, Nifty Realty. These indices have delivered positive returns in the last 1 year. Whether this trend is going to get reversed, IT is going to deliver positive return from now on, we don't know. We have to wait and see. But this clearly shows that IT stocks didn't perform in the past, in the recent past. However, in the last 5 years, they have delivered above average return. Now we have analyzed the details of the index and also seen the key features of the NFO. Now is the time to deep dive and analyze ICICI Nifty IT Index Fund NFO. When we did our detailed in-depth analysis, we found few insightful, enlightening, positive observations. First, I'm going to list down those positive observations. This fund is very reasonably diversified among top performing IT companies, that is diversified across 10 stocks. Investors seeking allocation to top IT sector stocks with a low expense ratio, this fund may be suitable to you, because in this fund, the fund manager is not going to do any fund management expenses. No analysis is needed. The fund manager is going to simply cut, copy, paste the index. Normally, in the actively managed fund, the fund manager will do all the analysis on the portfolio. He will check the balance sheet, profitability, capital efficiency, long-term sustainability. Is it easy to disrupt company or sector or not? Competitive edge, management quality, all those parameters the fund manager will check. Here, no such thing is going to happen. Because of that, the expense ratio will be very low. If the IT sector performs and delivers, then definitely this fund can deliver super duper return to your portfolio. If you are an aggressive investor, means like as it is a sectoral fund, it's not a well diversified fund suitable to aggressive investors. So if you are an aggressive investor and if you are bullish on the IT sector, you should be an aggressive investor, and also you have a compelling bright outlook on IT sector, then in that case you can go ahead and invest in this ICICI Nifty IT Index Fund NFO. When we did our analysis, we also found few important negative observations which can bring negative impact to your overall portfolio. So we are listing it down here. Obviously, it is an equity fund, can generate volatility in the short term, can generate negative returns in the short term. So it is not suitable for your short term, not suitable for your short term goals. Because it is a sectoral fund, also as a concentrated portfolio, not suitable for your core portfolio. In the core portfolio, you should have a well diversified, conservative, large cap, broad based index funds. That way, this fund is not suitable for your core portfolio. Being an index fund, it will mimic the index, replicate the index, and generate almost similar return to the index. They can't beat the index. Whereas in the actively managed fund, the fund manager will do all the analysis and pick and choose the best stocks. They will avoid well destroying stocks. They will avoid below average stocks. Because they are doing this exercise, actively managed funds has got the higher potential to outbeat the index. Whereas ICICI Nifty IT Index Fund will not be able to outbeat the respective benchmark index. Also, because of the tracking error and expense ratio, ICICI Nifty 80 index fund NFO can underperform the respective benchmark index. Being an index fund, this fund is not flexible and dynamic compared to actively managed funds. In the actively managed funds, the fund manager can move from large cap to mid cap to large cap. He can move from momentum stocks to value stocks. He can move from one sector to other sector easily. Based on the outlook, he can dynamically manage. Whereas in the ICICI Nifty IT index fund, even if the fund manager knows very well that the future for the IT sector is very dull, he is not having any other option except to invest in those top 10 IT stocks, even though the outlook for all those 10 stocks are very poor. Because by mandate, they have to simply mimic the IT index fund. This is a major disadvantage of this particular fund. Being a sectoral index fund, this fund can add more volatility to your portfolio, more risk to your portfolio. This Nifty IT index has got very concentrated portfolio, only 10 stocks, and top 2 stocks has got close to 53% weightage. So this concentration brings additional risk to your portfolio. If the IT sector underperforms, then in the last 1 year, IT sector has underperformed. Being an index fund, IT index fund, sectoral index fund, only if that particular recovers and performs, then this fund will deliver better returns. In the other diversified equity funds, if the IT sector is not doing well, the fund manager can move to other sectors where they have got greater outlook. Here it is not possible. So if the IT sector underperforms, it may take longer time to recover. So that way, you should have a time frame of 7 to 10 years. Normal 5 to 7 years time frame may not be applicable for this fund. In this fund, the fund manager will not do any analysis on the underlying stock. He will blindly mimic and replicate the index. Even if there is a very poor stock which is going to become a well destroyer based on his analysis, his hands are tied. He will not be able to avoid that stock. He is forced to invest even in that well destroying stock also, if it is there in the index. So, whereas in the actively managed fund, the fund manager can very well avoid such stocks. He can give higher exposure to stocks where the outlook is brighter. Because this kind of analysis is not going to happen in the index fund manager is simply taking the blind risk. Whereas in the actively managed fund, the fund manager is taking a well-calculated risk. As an investor, you should always focus on taking calculated risk. You should completely avoid taking blind risk. As an investor, when you take calculated risk, you are reducing the downside risk, increasing the margin of safety. Remember, risk management is under your control. Return management is not under your control. So as a prudent investor, focus on risk management and control the risk in your portfolio so that you will be able to manage returns. We have given you the complete analysis. What are the positives? What are the negatives? Now is the time to take a decision. Can we invest in this NFO or we should avoid this? It depends upon what kind of investor are you actually. Yes. If you are a first-time investor and if you are a conservative investor, then well-diversified fund, actively managed fund, or a broad-based index may be better for you. You should avoid this ICICI Nifty IT index fund NFO. Again, if you are someone who would like to invest in IT index, even in that case, you have existing Nifty IT index funds from other AMCs, other mutual fund companies with proven less expense ratio and less tracking error. Whereas in this ICICI Nifty IT index fund, we don't have a track record. Because we don't have a track record, we don't know what kind of expense ratio they are going to have, what kind of tracking error they are going to have. We are clueless. So again, from the expense ratio point of view, from the tracking error point of view, we are taking a blind risk. If we are choosing an existing fund with a track record, you will be able to very well analyze what is the expense ratio and what is the tracking error. You will be able to take better calculated risk there also. If you are looking for market beating returns, dynamic fund management, this fund is obviously not suitable. One more important parameter which you have to understand is, normally when you invest in a diversified equity fund, the fund manager decides which sector to give higher allocation. If he feels IT sector is going to do well, he'll give higher allocation to IT sector. When the outlook becomes dull, he will remove the exposure or reduce the exposure to IT sector, and he can move the exposure to where there is higher potential. If the FMCG outlook is better, he can give higher exposure to FMCG. Dynamically, he can change. Whereas in this particular ICICI Nifty IT index fund, as an investor, timing the sectoral allocation is on your shoulders. It is your responsibility. If you know IT sector's outlook is going to do well, then you can have better exposure, higher exposure. You can enter. If the outlook for IT index is going to be dull, then in that case you have to move out. So when to enter into IT sector, when to come out of IT sector, you should decide. It should be in your circle of competence, or at least your investment advisor or financial planner or mutual fund distributor should be in a position to do it. So if timing this particular sectoral entry and exit is within your circle of competence, then you can go ahead and experiment in this fund. Otherwise, better to avoid and choose well diversified portfolio funds. Also, before investing in this fund, please consult your financial planner. Why? Because your financial planner knows your complete financial roadmap. Where are you financially? Where you need to go over a period of time. You have to repay your loans. You want to buy a property, kids' education, kids' wedding, your retirement. You want to go for international vacation. All these major milestones, your financial planner knows how you are going to achieve these milestones with your present cash flow and future cash flow. He has that roadmap. In that particular roadmap, whether this particular fund fits in or not, based on your investment objective, based on your risk appetite, based on your financial goals, based on your risk profile, he will simply analyze and tell you, yes, this fund is suitable for you, this fund is not suitable. Also, one more important analysis you should ask your financial planner to do is, because you are adding this fund to your portfolio, to your existing portfolio, what kind of overlap ratio this is going to bring. You already have few existing mutual fund schemes in your portfolio. You may also have some stocks in your portfolio. Because you are adding this Nifty IT index, are you going to overlap the existing portfolio, or are you going to bring unique stocks to your portfolio, which is going to bring better diversification? This overlap or unique stocks is going to really beneficial to you or not. That your financial planner will be able to do an analysis and produce the report. Hope this 360-degree analysis on ICICI Nifty IT Index Fund NFO would have given you clarity. If you have any questions on this fund or any other investment options, or if you have questions related to achieving your financial goals, feel free to book a free appointment with our certified financial planners. To book a free appointment with our certified financial planner, I have given a link below this video in the description. In the description, I have also given you one more link, which is webinar registration link. We regularly organize insightful, enlightening webinars with eminent investment experts. They in detail discuss with you on investment strategies, wealth creating techniques. All these things you can learn easily and apply in your portfolio immediately after attending the webinar. And this webinar is completely free to you. Just leave your name and email ID in the webinar registration link. I'll book the seat for the next upcoming webinar and send you the invite. Hope you like this video and found it useful. I'll again meet you in yet another useful video. Thank you. Bye-bye.